Disney was originally founded on October 16, 1923 by brothers Walt and Roy Disney as the Disney Brothers Studio. Some 63 years later, the company changed its name to the Walt Disney Company in 1986 and is now home to a growing collection of iconic stories and characters. In this video, I'm going to discuss why there is significant value in holding Disney stock in your long-term portfolio, as well as provide a guide as to what price may provide this value. Now, let's roll the intro. Hi, my name is Nick, and this is another video in the series designed to provide insightful looks into the qualitative and quantitative qualities of strong businesses for long-term portfolios. As always, let's start with the qualitative side of the business. Disney's most valuable asset is its brand, which has been built piece by piece from nearly 100 years worth of content. Early in the company's life, Disney developed extremely popular cartoons and characters such as Alice's Wonderland, Mickey Mouse, and Oswald. These cartoons laid the foundations for the quality of content that was to be produced time and time again by the creative genius of Walt Disney. After countless Disney princesses and years of consistency, the Walt Disney Company developed significant customer loyalty as customers fell in love with their iconic characters and beloved stories. This enabled the company to leverage their content to create multiple revenue streams, such as their infamous amusement park, Disneyland. Other income streams include toys, Disney on Ice, Disney Plus, and many more. Now, Disney's brand and content have created a significant competitive advantage for the company, enabling it to grow to a peak market cap of $350 billion. The following video involves legendary investor Warren Buffett and his views on the brand power that is the Walt Disney Company.
The money is in, the big money is in the animated films and everything that revolves around that, because you go from films to parks to character merchandising and back, and I mean it's a circular sort of thing which feeds on itself. There's going to be plenty of competition in that. I mean you've seen what MCA and Universal's going to do in the parks in Florida, and you know what DreamWorks is going to do in animation, and now you've got new technology in animation, through Steve Jobs, and there's a lot of things going on in that field. So the question is, 10 years from now, what place in the mind, because it's a share of mind, it's not, they call it share of market, but it starts with share of mind. And what place in the mind of billions of children around the world and their parents does Disney itself have, and their characters, relative to that owned by other organizations and other characters? And it's a competitive world, so there will be people fighting for that. But I would rather start with Disney's hand than anyone else's by some margin, and I would rather start with Michael Eisner running the place than with anyone else by some margin. So that does not mean that it can't become a much more competitive business, because people look at the video releases of a Lion King and they salivate. You sell 30 million copies of something at whatever it may be, $16 or $17, and you can figure out the manufacturing costs, and it gets your attention, and it gets your competitors' attention. But going back, if I thought the children of the world were going to want to be entertained 10 or 20 years from now, and I had my choice of betting on who is going to have a special place, if anyone has a special place in the minds of those kids and their parents, I think I would probably rather bet on Disney, and I would feel particularly good about betting on him if I had the guy who has done what Eisner has done over those years presiding in the future. Charlie?
Well, I think it helps to do the simple arithmetic. Suppose you have 1 billion children of low middle income 20 years from now, and suppose you could make $10 per year per child after taxes from your position. It gets into very large numbers. And I don't know about your children and grandchildren, but mine want to see Disney. And they want to see it over and over and over again. They don't want to see Katzenberg.
Well,
I mean, in terms of the trade name.
it's a pretty good trade name. I mean, when you think about names around the world, it's interesting that there's very hard to beat the name Coca-Cola, but Disney's got it's a very, very big name. And Charlie's point that they want to see him over and over again, and it's kind of nice to be able to recycle Snow White every 7 or 8 years. You hit a different crowd, and it's kind of like having an oil field, where you pump out all the oil and sell it, and then it all seeps back in over 7 or 8 years.
Now that we know how strong the Walt Disney Company's branding is, we need to discuss how they are planning to continue to grow revenues and profits in the future. The major plans for continued growth are to continue producing original content and to acquire high-quality brands, which they see opportunity to create more content for. Examples of recent acquisitions include National Geographic, Marvel, and Lucasfilm. Each of these brands have significant fan bases that would be eager to pay for and consume more content. After the acquisitions, Disney has created more content in the forms of both movies and TV shows in which they display through another source of revenue growth, Disney+. Disney+ is Disney's streaming service that has seen rapid growth since its launch in November of 2019. Currently, it sits at over 150 million subscribers and is set to continue growing into the future as more unique content is created. Another source of revenue growth is the reopening of parks and cruises. Throughout the global pandemic, Disney suffered significantly, having to shut down their cruises and theme parks, which made up 33% of the company's revenue. Moreover, box office sales almost fell to nil as everyone was forced into isolation. Together, this resulted in Disney having to suspend their dividend, which seemed to be the last straw for investors. Now that people are returning to cinemas, Disneyland has reopened, and the Disney cruise has restarted, it would be reasonable to assume that it is only a matter of time before the dividend is reinstated. Despite this reopening, the stock price remains below $100 per share, which is over 50% down from all-time highs. Moreover, Disney has recently raised its ticket prices for Disneyland due to increased demand. While the global economy is in supposed turmoil, Disney is increasing prices. That's a very strong sign for the business. Moving on to the technical part of the video, let's look at Disney stock. Now, over the past year, the company's stock has seen a 45% drop, which is by no means insignificant. A combination of factors led to the beginning of the sell-off, as previously discussed, and as the economic environment worsened, investors have been jumping ship to safer asset classes. This created negative momentum which continues to push the price further down. Now, we as investors need to remember that we are buying part of a business and that if an excellent business falls to a fair price, we must be willing to purchase shares. Now, is Disney stock at a fair price yet? I believe so, although I would encourage caution, especially over the next few months, as we are on the brink of a bear market. As Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. Now, does that mean go ahead and unload your entire bank account into the market right now? No. But I do believe we need to be looking for opportunities that arise in businesses that we love. Let's take a look at the chart here. Now, on the monthly time frame, you can clearly see that over the life of the stock, Disney has been in an absolute monster uptrend, and this current 50% drop is merely a pullback in the grand scheme of things. When we move to the weekly chart, there is a clear level of support that we are sitting on at about $90 per share. And in fact, if we zoom in here, Disney actually bounced off this level in the past week. That being said, I think this is a time to show patience, as we will soon see whether the stock market continues the bear market or whether there could be a significant bounce. If Disney breaks below the support, the next level of support is right here at about $78.50 per share. Below that, I would not want to be a shareholder, as there is no structure until it drops to around $35 to $45. Overall, I think that if you believe strongly in this company in the long term, it is currently at a very strong buy zone. However, I would practice patience and risk management. My plan is to buy fewer shares of Disney at the current price and to wait for confirmation of either a strong rally or a continuation of the bear market. If you like this type of content and found some value in the video, please leave a like and subscribe to the channel. As always, I must stress this is not financial advice and that this is merely my personal opinion. Thanks for watching and good luck with your investments.